Good day, all. Ira Epstein of Linn Associates with your agriculture update for a wild trading day and everything. I mean, just everything on this Wednesday, the 14th of August, 2019, about 3:05 p.m. Central Daylight Time. Stock market, you can see a huge decline. Gold, even with that decline, is down $13 from its high. Silver selling off a bit. And of course, in the grains, more pressure being felt in the corn market as those long are just bailing. There's no choice but to do that if you're in a margin situation. And last night what happened is the exchange increased the margins in corn because it's moved so much. Remember what I told you? It's the first limit move to the downside in years, and one of the biggest moves in many, many years in a percentage of an up to a down instantly, and today just added to that percentage. Beans pulled back a little bit today. And in the grain market, just remember, now you're in the period where we'll worry about yield, not the acreage. The government's given you the acreage number. We won't know what that number gets changed to, if it gets changed, until October. So deal with yield, and that's it. You just have to wipe your hands and get back to doing what you do. In the soybean market, on the weekly area chart of closes, we had been up. You began a correction, as you can see, from this 906 area, ended up coming down, and you can see you came down to that low point, bounced back up to the 18-week average, and now you're at the other side, pulling back a little bit. But this is going to be the key area as far as I'm concerned for a bit here. There's less soybeans. That's what the acreage says. If there's less beans, any yield problem creates an issue in this crop. When you take a look at November soybean daily bar, I played today a little bit with this downtrend line. All you need on a chart are 2 points to connect to make what you call a line on it. So I'm going to use the high line here, and I'm going to use the line we made yesterday and just say that's the downtrend line for the time being. I'll be flexible with that. On the bottom part, all I'm looking for is a zone. And the zone that I've marched off, let me move back here, was a gap left way back here that I tied to that ran through this point. I'm looking for a wedge formation. Why? Well, when you get a wedge formation, if the market keeps coming down and you get over the top of the wedge, it's one of the 10 chart patterns that we teach in the charting course, that becomes a potentially bullish situation. Why am I still looking for anything friendly? Because the swing line still has a pattern of higher lows and higher highs. What else? We're fighting at the 18-day moving average of closes. I call that the line in the sand. That's often where a market fights a battle. We made a run towards the 100-day average yesterday, fell back, and are playing our games against the 18, and admittedly, we're at the lower part of the day's range today. If you take out this right here, the lows of yesterday, which was an outside day up, and that low was, 875 and a half. Well, if you do that, then I have to go back to the drawing table and say, okay, when that happens, it's a bit of what I'll term a bull trap, and I look to see, well, what is under the market then? And what would be under the market is the possibility of going back and challenging the Bollinger Band the way we did there. Not saying it's going to happen, but I'm fully aware that that could change this pattern. It would also keep you in that wedge, by the way. When we take a look at, let's go to the next chart, the slow stochastics, momentum is flat. So here's what we have. We have the swing line with the higher lows, higher highs. We have an outside day up, and you don't want to take this market down through that 855 and a half zone. That's what it did. Did I say 855? 875. If I could read, it would help me. That's the number you don't want to take out. As long as you don't take that out, you keep this pattern. Take that number out, and you could set up the momentum back down to the lower Bollinger Band, okay? On the way back up, if you don't take it out, first resistance, 18, then the 100-day. In the meal market, you're stalling against the 18-day average of closes. No surprise there at all to me. That is the line in the sand, and I say it so often. Markets like to go to that number to figure out what to do next. Are we trending here? Absolutely not. You have a lower low and a higher high pattern. That is not a trend. Because the market hit the 18-day average and settled under it, the bias is down. And when looking at momentum, it's nothing. It's just drifting right here at a number that is oversold. In the soy oil market, yesterday, not today, the market had an outside day down, and today about unchanged on the day. You're overbought. Markets had a bullish switch over of the moving averages. The 18-day got over the 100, and it's still there. This is a good support area, and on a pullback, I'll be looking to see if you can develop a pattern of higher lows, higher highs. Right now, you don't have it. You have what I'll call a vertical price move. You can buy it here and put a stop under the most recent low. You might, but it's not my cup of tea. In the corn, a vertical decline from 424.5 all the way down today, 50 cents now. And that all happened in 3 days. So a big price break. You're ahead of yourself because your days under the lower Bollinger Band are here. They were here. And on this day, you settled at 392 3/4 under the lower Bollinger Band of 97.5. So you have 3 days in a row down. I count each successive day above or below a Bollinger Band is taking away one of the 5 percentage points. What do I mean? 95% of the time, the algorithm that a Bollinger Band says the market will trade within the bands. When you get into successive ones, as a rule of thumb, that's all it is a rule of thumb, it tells me that I got 2% chance tomorrow of staying under it. Is that where you want to initiate new shorts? It's another way to say it to yourself. Well, 2% chance of staying under it, 98% of the time the market is going to be within the band. Maybe I can mentally do better. Think of it that way. It helps. In the wheat, you went down to the Bollinger Band yesterday. You bounced. You're still not back under it. Battleground is that number. Again, no trend. You've got the higher high, the lower low, and oversold. In the sugar market, if today's low is taken out, the bears will ask, can you get back under the 1190? If you can get under that 1150, I'm telling you, I've got to wear my glasses again. If you get under 1150, 1134, the lower Bollinger Band becomes a key number. As it is right now, let me point this out. Yes, we have the lower highs. We also have something else. We have a higher low. Do you agree with that? This is a low, that. So you're doing this. You're bringing prices in like that, and momentum is flat on you. You're not getting a lot of edge on this one way or the other. In the coffee, today you were down again 180 points. The terms of momentum in the slow stochastic, this is very unusual, to say the least. You lose the embedded reading right here. One of the numbers gets over 20. The only time you can re-embed is the next day. You came down, you're re-embedded. Yesterday, you lost the embedded reading again. You can see it right here. Today, it re-embedded. This is rare. Go in your charts and find it. I can't remember one in the past year on a lead contract, okay? There's nothing unique, it's just rare. Momentum is waning, is the way to say it, up or down, and the market's just drifting right here with a pattern of a higher high, lower low after a big move to the downside. That does not mean it can't go lower. If the market stays down tomorrow and keeps the embedded reading, the way that I teach, that market puts into play the lower Bollinger Band again, 96.28. So I'll be watching more out of curiosity than anything else. Cocoa, look at the size of this break that's relentless, and that's accompanied by a lower Bollinger Band that is embedded. It's accompanied by a market that has run that band, moved to the right-hand side, stayed within it, and still letting go. It is extreme. When you come to the cotton market, you're an oversold market that has the swing line with higher lows, higher highs, and the bias down. Lots of divergence right here. Cattle market, wild day today. They finally traded. So you had a range of 160 to 98.40, and the market finished down on the day, 75 points, not much of a decline. You've taken so much air out of the market with that Tyson plant that burned down in Kansas and not getting bids for animals in that particular area. In the feeder cattle, this is a pretty ugly chart. Let me show you. You had an outside day down yesterday. Today you get through that high, moving to the right-hand side of the Bollinger Band. That screams to me as a chartist, market doesn't know what to do. In the hog market, this is just plain sideways action in an oversold market where we're watching, but that's all that you can say. Trend down, bias down, oversold. Put it together, You still got all this to deal with in the stock market, and it is one wild day. Now, on days like today, when you get all this crazy action, what it sets up, sometimes early in the day, are extremes. You follow the margin money coming out of a market or going into a market, and you'll get to a higher low point early, and pivot point traders use that. They're looking to come into the market against what it's doing. So let's assume the pivot point, which is this dashed white line, is your neutral number. Well, if you get down to the first support zone, they're looking to be a buyer for prices to come back to this number. They'll flip that if the market rallies first, and they'll be looking for the sale to get back to the pivot. You're looking to get back to a neutral number. Pivot points are not meant to be a tool that one would use for trend trading. It's primarily for intraday trading, and I tie it to slow stochastics, which most people don't. And by tying it to them, I'm able to see, is the market overbought, oversold, and I filter the ideas there with it. Now, I've created a 3-part video series for you if you're interested in learning it, and it is free. Just simply go to our website at www.iraepstein.com. You'll see our carousel of free offers temporarily. I say temporarily because we're going to change our website, we hope, this week. And at that point, when you see the carousel, click on anything. You'll be able to fill out the form and ask what you want of different products. Do that one and be sure to send it to you, and it comes out via email. You can also click up here if you're watching me on YouTube. I'm Ira Epstein. You have a good day, and I'll see you tomorrow.